That's the closing bell on Wall Street. And now it's Market Domination Overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us here to break it all down. Jared, what happened at that close?
Thank you, Josh. We got a lot of green across the board here. You'll see that on your screen to the right. And not a lot, but I think investors will take that even as we are almost done with September. And by my historical records, the last 6 to 7 days are usually negative. Not today. So this is the intraday price action in the Dow. Not too far from the highs of the day, yet not even putting on 100 points there. 68.78 to be exact. And the Nasdaq making a high early on, kind of stair-stepping down, up for 50 basis points or so. And the S&P 500 about half of that. And let's check in on the small caps. S&P 600 up just 7 basis points. And if we go to the sector action, we're going to see a lot of green here too. Not in energy. That was a winning trade last week. But this week we got tech finishing Monday strong. That's up 0.5%. Followed closely behind by financials. Then we got consumer discretionary, materials. So interesting mix of cyclicals there, maybe a little value thrown in. And if we take a look at the Nasdaq 100, we can see NVIDIA up another 2%, Amazon up 1%, but we do have some red in the mega caps. Broadcom down 2%, Alphabet down about half of that. And some of the big outperformers today were in the semiconductor space. I'm looking at Micron up 4%, Western Digital up 9%. And then in software, we also got some big names. Shopify up 6%, Datadog up 4%, so is Electronic Arts. And I want to close here on the futures. I didn't get to this earlier, but I got to show you the metals doing really strongly today, and that's as the dollar was down. Copper up 2.9%, platinum up 2%, natural gas, we're going to move on from there. But gold, another record for gold. And let's just get the year to date. 45%, 38.57, put it in the books. Gold just really soaring here. I'll add to that. Silver up 58%. That is a 14-year high, Josh.
All right, thank you, Jared. Appreciate it. Markets may have defied the usual September gloom, but entering October, investors are watching valuations, earnings, even the possibility of an AI bubble. Joining us now is Sandi Bragar, Chief Client Officer at Aspiriant, to break down what could keep this rally going and what risks may be lurking ahead. Sandi, it's good to see you. So we heard so much about negative seasonality, Sandi, but September hasn't seemed at least so spooky, and now we're heading into October. I'm curious what you see ahead.
Josh, we think the stock market has been having a great year so far. The economy is still strong, and that should help carry us through. That said, we think investors should be really smart about how they're allocating their portfolios. And for the portfolios we run for our clients who are corporate executives, family business owners, entrepreneurs, and inheritors, we're tilting away from the normal stack of the market. Within the U.S. stocks in particular, we're tilting towards small cap. We think that there's a lot of room to run in small caps, looking beyond just the fourth quarter, but into the next couple of years.
Is your confidence in small cap, Sandi, you just think, listen, the economy seems to be broadly hanging in there and the Fed's cutting?
Josh, over the last couple of years, small cap stocks have faced an earnings recession. They've been battered by high wages, inflation, and high interest rates. Having the Fed begin an interest rate decreasing cycle has certainly helped them. When the Fed decreased rates by 0.25% a couple weeks ago, we saw a 2% rally in small caps. So we do think that their headwinds are starting to reverse. If we see some more easing of interest rates, that should help blow some wind into their sails. A lot of small companies here in the U.S. rely on debt heavily to finance their operations and their growth. So any decrease that they can get in interest rates really helps them increase their overall earnings.
What about that mega AI trade and trend, Sandi? It's been so critical for the market. Does that trend look intact to you? Because there's been some very well-known investors kind of throwing some red flags here, bringing up some concerns about all that AI spend.
Well, I think AI spend will continue to be with us for quite a while. There's some really great technology happening there that should have a deflationary impact on the economy. That said, Josh, as we look over our shoulders at the month of September and the quarter before that, we see a widening of earnings growth across the S&P 500. 11 out of 12 sectors experienced surprise upside to the earnings per shares that they were reporting. And we think that trend will continue. So we're not advising clients to get out of technology, but we're definitely weighting the other 493 stocks in the S&P 500 more heavily. And as I mentioned before, really tilting into the small cap stocks because we think they are going to outperform.
Earnings season, Sandi, is going to be here before we know it. I'm just curious about your expectations there. What do you think CEOs and CFOs, what are they going to report, and what do you think they're going to say about the future?
I think for the quarter just closing, I think we're going to see some continued strength in the earnings that companies are reporting. There's still a lot of trade issues that are getting worked out, trade policy changes. We're waiting anxiously for the jobs report that's supposed to come out at the end of this week that will give us some more indication of what's happening in the economy. But we think that the CEOs will generally be positive. And for the time ahead, I think there is just a lot of risk and uncertainty out there that they're having to navigate every day. And I don't think that's changing at all.
The Fed cut, Sandi. Does the Fed need to keep cutting for this market to move higher? The market wants that, but does it require it, Sandi?
I think that the market definitely is expecting more interest rate cuts. I think if the Fed doesn't deliver them, I think that could cause some market volatility because we think that there's at least one, maybe even two rate cuts priced in. I don't know that further rate cuts are going to prop this market up more, Josh. One of the questions we're getting most often from clients is the market at its peak? Should we be selling? Should we be doing something different? And we're absolutely telling our clients to stay invested. It's really important. Certainly if someone has a high need for cash to cover a high priority short-term expense, then make sure that you have cash for that. But otherwise, stay invested. And like I said before, make sure that you're really thoughtful about how you're allocating your portfolio. There's certainly parts of the equity markets and also the bond market where we see a lot of opportunities for investors in the weeks and months and quarters and years ahead.
Well, what is your advice specifically for fixed income investors?
Yeah, so on the bond side, because we're working with clients who tend to be in the highest tax brackets, we have a preference toward muni bonds because of their tax-free nature. And within the muni bond space, what we've been noticing is that the yield curve has really been getting higher as taxable bond yields have stayed pretty flat. So when you look at a 15-year bond and you compare munis to treasuries, the munis are delivering about 90% of the yield as the treasuries, and that's before considering the tax impact, the tax favorability of munis. Whereas if you look at that same ratio at the 5-year bond term, the yield is more like 65%. Munis are delivering about 65% of the treasury yield. So we think going further out on that yield curve for munis makes a lot of sense. And we've been tilting about 20% of our clients' fixed income allocation toward those longer term muni bonds.
Final question, Sandi. Possible government shutdown. We're all placing our bets here. As an investor, does that concern you, Sandi, or do you say no? That's it gets a lot of attention, it gets a lot of headlines, but investors should look through it. What do you think?
Well, certainly it would be better if we didn't have a shutdown, but history would tell us that government shutdowns don't tend to have a big impact on the economy, which means that they shouldn't have a big impact on the stock market. So we prefer not to see one, Josh, but if we get one, we don't think that's reason for panic.
Sandi, great to have you on the show today. Thank you.
Thanks so much.
Coming up, more Market Domination Overtime when we return. Western Digital, one of the top performers of the S&P 500 this year, is seeing several analysts raising their price targets on the stock. Yahoo Finance spoke with one of those analysts on that bullish outlook.
Two big aspects of the change. One is all the AI data centers that are being announced and plan to be deployed over the next 2 years, maybe even 4 years. And all of the data centers need storage. And that's what Western Digital provides, is hard disk drives that offers the lowest cost mass storage of data in the world. So every data center needs lots of storage. The more data you have, the better your AI outcomes will be.
So Kevin, without getting too technical, Let's break down for folks a little bit about what role hard disk drives play. Now, I know I got a hard disk drive in my computer, right, that provides storage. In most PCs, I guess all PCs, they have hard disk drives. When we're talking about the role that they're playing in a data center, what exactly do they do? What function do they serve?
Well, it is just storage of data. So maybe if you even use Yahoo Finance as an example, and all your videos that you have made and you've stored all in hard drives, that's the lowest cost. And you use that data to run algorithms, artificial intelligence algorithms, and maybe you can find out which of your shows gets the best ratings, or you can optimize what your shows would be. But the hard drive has to be used to store this tons of data.
I love the Yahoo Finance example. We'll have to use that going forward for all of our segments and real world examples. So you have a Western Digital, you have Seagate, which also provides hard disk drives, which has also done very, very well. Is this something where it's a tide lifting all boats with this AI demand and the build out of data centers?
Yes, it is. As you mentioned, your PC has a hard drive in it, or it used to be just about every PC had a hard drive in it. And over time, solid state drives, these are made of NAND flash, they use lower power. You can put more data in the same amount of space. So the solid state drives started replacing hard disk drives. So that was a headwind for both Seagate and Western Digital for their longer term growth. But now that I would say 90% of PCs use solid state drives and not hard drives, they don't have that headwind anymore in revenue. And now it's only going into the cloud data centers, which giving them now revenue growth in 15% per year over the next 5 years. So they're experiencing new levels of growth, and they're also experiencing new levels of profitability. And that's what's really changed. And the market is now giving them a higher valuation for their profits because of the growth rate.
Is there any risk that you would see a migration in data centers like we saw in PCs?
Well, in a PC, you could only use so much data. Maybe 1 terabyte is probably plenty for most users. But in data centers, as I mentioned, they're trying to store every piece of data for companies. And a hard disk drive per bit is probably 8 times cheaper than a solid state drive. So we think the lower cost is going to win out in the longer term.
One of the things you talk about in your note on Western Digital is their sort of build to order strategy. In other words, they're not building in advance and hoping that people buy it, I assume is the way that this works. How does that give it an advantage?
Yeah, that helps you control your supply chain, and you don't end up with the cycles that we've seen so many times in the memory and storage industry. When you have 300 customers, you have to build for inventory, and you're never sure which one of your customers is going to have too much inventory, and it would cause a inventory digestion or a slowdown in revenue. Now there's only, we'll say, 10 customers that are dominating their orders for both Seagate and Western Digital. And if they can get a 12-month backlog, they can now control their supply chain more effectively. And that, again, helps gross margins go up when you have better control over your supply chain.
Kevin, we've already seen the stocks do really well. Whether you look at a Western Digital, whether you look at a Seagate, or for that matter, a Micron, whose chips go in to provide this memory and storage. How much of this outlook do you think is already priced in? How much upside do these stocks have?
Well, I think we're seeing it today. That I went back and looked at my model and said, if we have Oracle announcing $300 billion of new deployments and OpenAI getting a big investment from NVIDIA, then I was only looking at maybe 2 years from now 6 or 7% revenue growth, but now we're feeling a lot more comfortable that could even go up to 10% revenue growth based on all this new announcements. And we don't think that these announcements they have to be planned now, and getting the storage is part of that planning. So we think this is where the valuation metrics that you use goes up, because you're more confident in their revenue over the next 2 years.
Well, and I guess if you're comparing them, I've talked to a lot of investors who say even NVIDIA is not necessarily overvalued because its earnings are rising along with its price. But if you look at these guys, I mean, at least on a pure PE basis, price to earnings basis, they're a lot cheaper than some of the other choices out there, right?
Yes, they are. But they're a lot more expensive than they have been historically. Again, when they had exposure to the PC market and was only growing 3 to 5%, and they had 30% gross margins, they traded around 10 times forward earnings. Now they're trading closer to 15 to 20 times because their top line is growing 15%, their gross margins are over 40%, and they have predictability in front of them. So the market is giving them higher, but a higher valuation, but nowhere close to NVIDIA that is, of course, running at 75% gross margin. And so they trade at 35 times forward earnings.
Progress Software's third quarter results showing a beat on earnings and revenue. CEO Yogesh Gupta joins us now with a closer look. Yogesh, it's good to see you. So print just crossed your Q3 adjusted EPS at 150. That looks like a beat, Yogesh. Your Q3 revenue at 249.8 million. Also, that looks like it beats consensus. You raised, it looks like here, your full year guidance for revenue. Walk us through the report, Yogesh. What are you seeing in the business?
So Josh, thank you for having me on the program, and delighted to be discussing the results with your audience first. We are actually seeing meaningful demand driven by the AI projects that our customers are implementing. We are seeing increasing demand for our products that help them with their data, that help them get value from their workflows and automate their workflows, as well as leverage their IT infrastructure for business advantage. So all of this is driving our results. We had really good results, as you said. We exceeded top line. On revenue, we delivered a significant upside on our EPS. We've raised guidance on both revenue and EPS, as well as on cash flow for the year. And we see continued strong demand driven by the AI initiatives of our customers.
I think, Yogesh, when folks think of Progress Software, many, Yogesh, might still think of sort of a traditional software player. Can you walk us through exactly, Yogesh, sort of your company's role in this new world of AI?
Absolutely, Josh. The interesting part about Progress is that we have a portfolio of products that covers three major areas. The first area is around leveraging data. So all the businesses have this mission critical data, and now they want to use it for AI. They want to get trustworthy, accurate answers that are relevant to their business using this data when they use Gen AI. And our data products do exactly that, right? We create this retrieval augmented generation, or RAG, solution for Gen AI, and it is something that helps our customers, large and small, get tremendous value out of the data. So that's part one. Part two of our business is around automating workflows and creating great digital experiences. And even again there, we have created Gen AI-driven workflow automation, as well as help with their user experience and building wonderful digital user experiences for their customers and their users. And then last but not least, when you have a lot of IT infrastructure because of your AI efforts, right, you need something that can manage it in a way that is automated and, again, leverages AI. So we have an infrastructure management software solution set that helps make sure that everything is reliable, available, and secure, and uses AI for all of that as well. So it's actually AI throughout our portfolio. We have continued to innovate across the portfolio over the last several years, and we're really excited about what lies ahead.
And so, Yogesh, for viewers listening right now, can you help us quantify it a bit more? What percentage of your revenue, Yogesh, is related to AI now, and also what do you see ahead?
So, that's an interesting question, Josh, because when you think about it, right, when you say what percentage of my business is related to AI or revenue is related to AI, the question really is, what projects are people doing that are driving the revenue, right? And so really, the vast majority of the business in that sense is supporting AI projects. Now, some of that might be sort of what they were doing before anyway, right? Because that is all foundational information needed for AI. So we're seeing growth primarily because of AI. And I think that's where we're seeing the upside. We're also, by the way, we made a great acquisition last year, our largest acquisition to date that has gone really, really well, called ShareFile. And that continues to grow because of its AI capabilities that were built in even before we acquired it.
Finally, Yogesh, investors do have questions about the macro, about tariff uncertainty. Are you seeing any of that show up in the business?
Josh, not really. I mean, we are confident about our where we're going. We're confident about what the market demand is, which is why we're raising guidance for the full year. Obviously, we are watching the macro. We would always like the macro to be better, but to be honest, we're seeing a significant demand for our products because our products help businesses optimize the work that goes on. Right. And so when you are about optimizing the work that goes on, you're making the business more efficient, right? When there is pressure from other costs, actually software that helps businesses do their work much more easily with, significantly less resources, much more efficiently, reliably, accurately, that software becomes more valuable.
Yogesh, thanks so much for your time today. Appreciate it.
Josh, it's a pleasure. Thank you for having me.
Time now for what to watch Tuesday, September 30th. We're going to start off in Washington. We're watching for a potential deal to avoid a government shutdown. President Trump meeting with congressional leaders on Monday, trying to reach a deal before the looming deadline on Wednesday. Moving over to earnings, Nike's reporting results for the first quarter on Tuesday. That's after the markets close. Analysts expecting Nike's sales to continue falling, but the declines may not be as bad this quarter. Profits are being squeezed by tariffs and a weak demand in China, and investors are eager to see if a product refresh can return momentum. Taking a look at the economy, new data on the consumer coming in on Tuesday with consumer confidence. Economists forecasting confidence to fall compared to August to 96, signaling people may be slightly more cautious about spending, jobs, and economic conditions. And finally, we'll be getting some more insight into the job market on Tuesday with the job openings and labor turnover survey. Job openings expect to hold relatively steady at 7.17 million, suggesting little change in demand for workers. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.